All right, so I welcome you all once again to Target Professional Consults. Today we are going to look out for one of the interesting sections, that is the IFRS 5, and we intend to detail every issue about the IFRS 5. We talks about the non-current asset held for sale and discontinued operations. So that's the issue that we are going to look out for today. So first, we'll go through the sections and then we move on. So to start with, it's an interesting topic. Just to start with that, first of all, you must know the reason for non-current assets. You see, you must know reason for the acquisition of non-current assets. So before we have the non-current assets. Let's tell some unique features of non-current assets. They are assets that you acquire not for sale in an ordinary course of business. So they are not for sale in an ordinary course of business. Ordinary course of business. In simplest language, it is not the asset that with an intention, you acquire with an intention of reselling it. No. But it will mainly for use. So for use too, we have three kinds of use, three forms. Use in production, use in the production of goods and services. We are describing non-current assets and what led into IFRS 5. Again, they are assets that you can also be used for administrative purposes. Basically, you can use it for administrative purposes. So, for administrative purposes. Or for rental. For rental. The last feature of non-current assets is that they usually last for more than one financial year. So their benefit lasts for more than one financial year, or the expected life goes beyond one financial year. So the expected useful life goes beyond one accounting year or one financial year. That is it. So take notice of this and then we move on with the game. So the issue is this. You see, I want to break certain standards down for you to get it. This standard is a standard that you must understand it with a full knowledge. You must first of all understand why the existence of non-current assets and why they suddenly change. So that is what I'm trying to tell you. So please take notice of that. So first, non-current assets exist for three issues. Three issues. They exist not for sale, please. And they exist mainly for use. So, and if you say use in financial reporting, there are three ways of using an asset. Either use it as your production plant for manufacturing your goods, or for administrative purposes, or for rentals. For rentals. Good. And then that is the case. But their useful life goes beyond one financial year. The expected useful life goes beyond 1 year. That's the reason. So along the line, there will be sudden change. So there will be a sudden change. And then the entity will now classify the assets that originally were not meant to be sold, now for sale. Do you get it? So the entity will now classify the asset that they acquired with an intention not for sale, now for sale. What will cause that? Please know the reason. Two, know the accounting treatment. That's the fundamentals. All this meeting is to try to tell you how the entity should account, should go by anytime they change their mind on what asset that are not meant to be sold, and now they are going to sell it. So now let's go. So along the line, there will be a need for the examiner or for the entity to dispose of that asset. In that case, how do they account for the disposal of non-current assets? So question mark. And somewhere in 1998, so 1998, IAS 35 was issued to talk about discontinued operation. But thank God, after the revision in 2001, in 2004 again, IFRS 5 was issued. So now here comes IFRS 5. So IFRS 5 came to come and solve the problem of disposal of what? Non-current assets. Even though there was what? Earlier standard issued, IAS 35, it has been cancelled already long ago. It was there to solve the problem. But the issue has to do with the IFRS 5. And then that is all. So please take notice as we go through the sections. And then we move on with the game. Now let's continue. So IFRS 5 came in to solve the problem. So IFRS 5 is for non-current assets held for sale. That's one thing. And discontinued operation. Discontinued operations. So that is what IFRS 5 talk about. So over here, two things you must know. Non-current assets that are held for sale. So when the entity decides to change their mind on the use of the assets, and then we move on with the game. So first thing is to prescribe the objective. So let me go step-by-step approach. First, what do you think will be the objective of this standard? Now, objective of this standard is very simple and very straightforward, because they cannot, or we cannot bring a standard that talks about non-current assets held for sale, and then we'll prescribe something else. So you can deduce the objective from the name, and then we move on with the game. All right, so the objective of this standard is to prescribe the accounting treatment for assets held for sale. To be specific, non-current assets held for sale. And then the presentation and disclosure of good. So that is it. So now, yes, this question came in. There's a question here. The disposal of non-current assets, which standard governs that? That's the IFRS fact. So as a result of this question, how do we dispose non-current assets? What are the procedure and the methodology that came or that called inward IFRS 5? So that brought IFRS 5 into the picture. Good. So anytime you are going to sell your non-current assets, we need IFRS 5 in position. And then that is it. So let's take note of that. All right, so let me continue. Thanks for the question. Now the objective is to, first objective is to prescribe the accounting for assets held for sale. So that's the first objective. So to prescribe let's say non-current assets. So prescribe the accounting treatment for non-current assets held for sale. So to prescribe non-current assets held for sale, we say accounting treatment. So let's go. Accounting treatment or accounting for non-current assets held for sale. So any there. And two things, presentation and presentation and disclosure of disposal group. Or discontinue operation. Let's make it discontinue operation. Discontinue operations. You see how the system works? So here we are describing two things here. So take notice of that. The very first one is to talk about how we should account for any asset that probably have been classified for sale. At the same time, to prescribe how we must present. So you see, the discontinued operation is about presentation. And IFRS 5 is much particular about how you present discontinued operations. And in the accounting disclosure, you must disclose any operations that have been demarcated with that regard. That's all. So that is a treatment, or that's the objective of the IFRS 5. So to be specific, we also learn the prescription or the criteria before we can classify an asset as what? Held for sale. So take notice of that. It also gives the requirement on that, and then we move on with the game. Now let's summarize the scope. It's very important here. So I'm going to talk about the scope. Scope simple means the coverage. So does it cover all non-current assets? No, the exceptions. So take notice of the exceptions. The IFRS 5 covers all assets that are held for sale, but not to all. So here, take notice. So it's IFRS 5, it applies to all non current assets held for sale or non-current assets held for sale and discontinue operations of the entity, except the following. So except, please note the exceptions. So all the following IFRS 5 does not apply to what we are going to list. So take notice, IFRS 5 does not apply to what we are about to mention. First on the list is deferred tax assets. So take notice that deferred tax assets is not, even though it's an asset, please, deferred tax assets is not under IFRS 5, cannot be recognized or measured under IFRS 5. So that's the first issue that we'll talk about. The deferred tax assets. You can get that on IAS 12 as you've read it, IAS 12 good income tax. So these are the exceptions. So when they give you IFRS 5 question in exams, and realize that it contains deferred tax asset, please, and they've asked you to measure that or recognize that using IFRS 5. When you read deferred tax, please exempt. Do not apply it to the deferred tax. Item number 2 that IFRS 5 does not talk about is asset arising from employee benefits. Good. So assets arising from employee benefits. Assets arising from employee benefits. Clearly, you can get that from IAS 19. So you can get it from IAS 19. That talks about employee benefits. Over there, so if you have a pension assets, you cannot measure pension assets under IFRS 5. In the event where you want to discontinue that pension asset, please. Item number 3, that's IFRS 5 does not. And all these that we are mentioning, they are on their own. There's a bigger standard that talks about that. So take notice of that. The third one that we'll talk about is financial assets within the scope of IFRS 9. All financial assets. So take notice, financial assets. So financial assets within the scope. So financial assets within the scope, in the scope of IFRS 9. You get that? Good. So IFRS 9 financial assets, you cannot impair financial assets under IFRS 5, even if it's held for sale. So the available for sale financial assets or financial instruments, we have to account for that under IFRS 9, not IFRS 5, even though that instrument or that financial asset is classified for sale, not at all. Item number 4, that the requirement of IFRS 5 does not govern, should be. Now, non-current assets accounted for under the fair value model in IAS 40. So non-current assets, or I will say that investments, properties held under fair value model, held under fair value model. So all this held under fair value model. And that is IAS 40, talks about that. You must know all these, the standard that talks about them. And then we'll move on with the game. Item number 5, that IFRS 5 doesn't talk about it. Please, at the final level, we cannot set questions solely on IFRS 5. It must be mixed. So if you check all IFRS 5 questions, either it's coming with PPE, IAS 16, it will come with PPE, it will come with IAS. In fact, sometimes it even comes with inventories. PPE will be there. And then you see a lot of investment in. You see something like investment property will be in, IP will be in, inventory will be in, receivable will be in, financial instruments, even if it's a disposal group, you see all the rest of the assets within that group. Not all of them will be measured under what? The IFRS 5. Let's take notice of that. Again, so the item number 5 that we don't talk about it here is non-current asset measured at the fair value. Let's go to sell in accordance with what? IAS 41, agricultural produce. So non-current assets. So the non-current asset measured under non-current assets. Measured under fair value less cost to sell. In accordance with IAS 41. So take notice of that. In accordance with IAS 41. Done. So these are the examples of the exceptions. So all these you cannot record using IFRS 5 because there's a bigger standard that talks about it. So I'm done with the scope and I have to go through some definitions and we proceed with the issue. Now, with these definitions, it's not something that is to be worried about. So I can even skip that one in addition. However, you must also know this. Please, let me add this one to it. Number 6, let me add this. It's very important. Non-current assets that are to be abandoned. Yes. So the entity shall not classify as held for sale a non-current asset that are to be abandoned. So please take notice of that. Non-current asset that are to be abandoned. So non-current assets that are to be what? Abandoned. So if we are to abandon a particular asset, so Good. So if we are to abandon a particular asset, we cannot record it as a non-current asset held for sale. If we are to abandon the asset, the reason is very clear, and we explain why we cannot record non-current assets that are to be abandoned as what as held for sale, because the current amount will be recovered principally through its continued use. Good. So that is why we don't record abandoned assets. Now, when I go through extensively the recognition, you'll get it clearer. Now, let's go to the recognition criteria for recording or for classifying assets as held for sale. So we are going to take our time, which asset meet the condition, and that is where you know where all the some of these assets fall short of. Yeah, so first, let's discuss the recognition criteria. Recognition criteria. So what are the conditions for recording or condition for classifying asset as what held for sale? What should be there before you can classify asset as what held for sale under the IFRS 5? So know the conditions very well. The first condition is that if and only if the carrying amount of the assets can be recovered principally or mainly through what? Through sale. So take notice of that. So imagine you have an asset, and that asset that you have, in fact, the carrying amount cannot be what? Generated through use. So we have an asset. When we use it, the value, we can't generate its value. Imagine the value is $40,000. That's the carrying amount. But when we use this asset, we cannot generate $40,000. We can't. We can generate something lower than that. But we can get a substantial value when we sell. So the carrying amount can only be generated or can be recovered through what? Through sale. So that's the first condition. So before you classify any of the assets, don't forget the reason why we bought the asset. We bought the non-current assets just for what? For use. So if we should go to the first section that we did, you see, non-current assets are acquired mainly for use. Take notice of that. Mainly for use. So anytime you change that, anytime you want to sell, the first condition is that make sure that the asset carrying amount can only be recovered through sale, but not what? Use. So imagine the value is $40,000. When I use and when I sell, which of these options will let me recover my 40,000 fast? So you only classify it for sale if when you use it, you won't get the 40,000. Instead, you must sell it in order to get your 40,000. In that case, stop and now classify the assets as what? Held for sale. So that's the first condition, and it's a very powerful condition that brings the held for sale into being. So make sure that the asset value can only be generated or can be recovered mainly through what? Through sale rather than what? So take notice of that, and then we move on with the game. So if you get that side clear, and it means that we can now move on. The conditions are mainly to you, so we have to get to all of them, and then we move on with the game. So let's go back to our section. So let's go back again. So if the carrying amount can only be recovered through sale rather than use. So take notice of the condition. Then the condition 2. So you see, condition 1 clearly states that if you can only recover the value of the assets. Yes. So that's what it's trying to tell us. Okay. Again, the condition 2 is come to prescribe. It's come to prescribe what we have to do. Good. Now the condition 2 states clearly that if and only if the sale is highly probable, so it's probable that the sale will be done in 1 year. That is it. So they still have to be done in what? 1 financial year. So meaning that it must be highly probable that the sale will be done in 1 year. Good. Or the sale must be highly probable. So the next one says that the sale must be highly probable. What are we trying to say over here? So you can only classify a non-current asset as held for sale if and only if, 1, you can only recover its carrying amount through sale rather than use or rather than continuous use. If you continue to use the asset, yes, rather than its continuous use, and then that is it. And if and only if the sale must be highly probable, it means within 1 year, within 1 financial year. That's what we are trying to talk about. But we have exceptions. So, and we went further. How do you test for the second condition? So there are a lot of ways of testing for the second condition. So to know or to identify or to prove further that this sale will take place within 1 year, the standard provides much more detailed information. Now, for the sale to be highly probable, there are a lot of conditions. Good. Before the sale will be highly probable, the asset must be available for its immediate sale in its present condition. And it's very important. So first condition, all these are part of the condition. 1, the assets. So the assets in question. Yes, the assets in question must be what? Available. So third examiner must be available for its immediate sale. For its immediate sale. So take notice of that. For its immediate sale in its present condition. Take notice. So here, meaning is that the asset must be available, because you can't sell asset that is not available. That's not ready yet. That's not available. It's not allowed, please. So we are not going to agree with that. So before the sale can take place within 1 year, make sure that the asset is what? Available for its immediate sale in its present condition. In its present condition. So don't say that I'm going to fix the engine. When I finish fixing the engine for the car, I will sell. So let me write for sale on the car whilst I'm fixing the engine. It is not right in accounting terms, please. Take notice that it is not right in accounting terms. The condition. You see, I always say that if you meet any car, please take notice of this. If the entity is disposing its vehicle and you meet a car in the middle and your money is ready, you have to hand over the car to you. When they say asset is ready or is available for its immediate sale, all what you're trying to say is that, one, that asset, any point in time, when the buyer is ready, that asset will be exchanged. So if you meet a vehicle that has inscription for sale, and you approach them and say that, oh, give us some few days. We have some work for the vehicle. Let us complete it. We are in the middle of a work, even though there's for sale on it. Let us finish. When we are done, we'll bring the vehicle to your end, or we'll invite you to come for your vehicle. That vehicle is not ready for its immediate sale. So as soon as you put for sale on it, at that time, any moment, whoever is ready, the person must get the vehicle. Don't go and come the next day. Give us a week. You have some job to do. No. If you think you have some job to do, you will classify that asset for sale. So take note. If the asset have a job to finish all with the work before you classify asset for sale. So take notice of this classification, and it's very important. So I'm done with the first word, condition. So these are the conditions. And again, before the sale will be highly probable, you see, management must be committed. Yes, to sell the asset. So another rule is that management must be committed. So management must be committed. That's second. So management or the entity must be committed. You see, if you are selling an asset, you have to make sure that, in fact, you are ready to sell in all material respect. So management must be what? Committed to sell the assets. They must be committed to sell the assets. Committed simply, they have a plan. There must be a plan to sell the assets. And again, active program to locate a buyer. There must be an active program to locate a buyer. All these are conditions that suggest that the sale will take place within 1 year. So active program. So active program to locate a buyer. And that one, I'll give you the secret. Locate a buyer. That one means that the asset must be fairly priced. The asset must be what? Must be fairly priced. You see, the current amount of the asset is somewhere $10,000. That's the carrying amount of the asset. And you are pricing somewhere $80,000. You see, the value of the asset is $10,000, or even the price, the fair value. Carrying amount and the fair value is $10,000. No problem with that. And you are pricing $80,000. That means you are not ready. Like you just want to sell customers. That's all. Just tell us that you are not selling the assets so that we go. Don't put for sale on it that when somebody can, you have mentioned like times 10 of the current value. That means you are not initiating active program to locate a buyer. No buyer will come and then stay. So take notice of the active work or the active program. Good. And then the plan must be initiated. Good. And then the asset must be actively marketed for sale. So at a reasonable price. So take notice in relation to its current, that's the fair price I told you about. So that's all. So here the assets must be actively marketed. You see, marketing groups. Yes, so the marketing of the asset for sale. All these are conditions that you must what? Satisfy before you can classify your asset as what? Held for sale. Take notice of this one. Yes, so and here the asset must be fairly priced in relation to its fair value. So price the asset well. So fairly priced asset in relation to its what? So take notice. Okay, and then that's all. So we are done with the game. Now there are exceptions. I want to make certain things clear for you. Sometimes, yeah, you do all this. Don't forget that the most important rule or the conditions are only two. If you can recover the value, and if the sale will take place 1 year, that's all. Go ahead. So after 1 year, if you have not disposed of the assets, there's a problem. Good. So that one, there's exceptions. Sometimes you may do all this. The asset is available. You're not even using the asset. Management have committed to sell. The asset has been underpriced. The asset has been marketed. All the marketing groups have picked up the information, but yet still, you have not been able to dispose of the assets. Good. So we'll talk about that. So take notice of that. Now, so after 1 year and you have not disposed of the asset, what happened? Very important. So after 1 year, tell the examiner that after 1 year, what happened? And the asset is still, or the asset remains unsold. The asset remains unsold. What will be the treatment? Take notice that the sale must be within 1 year. Finish it up. That is it. So before you record any asset as held for sale, make sure that you can sell it within 1 year. And you can only sell within 1 year if these conditions are also there. The asset is available and you've done everything. The asset is available for sale. And then active program, the asset has been fairly priced, and then the rest. You've done all, but still the asset meant two things. One, if the reason is within the entity's control, they have to reclassify it. So take notice. So the reason. So if the reason, the reason for unsold is beyond the entity's control. This is very powerful, especially the final level students. Take notice of this. If the reason goes beyond the entity's control, then and the assets can still be classified as held for sale. B, as the opposite. If the reason goes beyond the, in fact, if the reason is within the entity's control, or the entity did not select the models well. So if the reason is within the entity's control, or as a result of management fault or management misapplication, entity's control, then the assets must be reclassified. What a wow. Let me take my time to explain. These are the exceptions. You see, if after 1 year you have not disposed of the asset, and the requirement before you can classify asset as held for sale, it should be probable that you will sell the asset within 1 year. Now, 1 year has come, you've not sold the assets. Why? If the reason go beyond your control, typical example, imagine target professional consults. We had a grant. Government supported us to buy certain assets. Target professional consults, we had a grant. We bought a particular asset. The government supported us. And the requirement or the condition, government warned us that anytime we are discontinuing the use of the asset, we must seek for permission. So anytime we are going to sell the asset, we must take permission. And government and their protocols. So we have applied for the authorization for sale, but government have not given us approval. So that is why we have classified that asset for long. So yes, we have met all the conditions for classifying the assets for sale. But due to the authorization that has to come from the state protocols or the Attorney General, and we have not gotten that permit to sell the asset, and so the asset is still out for sale. With this, the standard will allow you, IFRS 5 will allow the entity to go ahead and classify an asset for sale, because they know that the reason or the issue goes beyond the management control. Good. But if it is otherwise, if the reason is within your control, for example, the asset has been overpriced. Asset that is going for $10,000, you are quoting $80,000. Who will buy? Asset that is going for just $20,000, you say the person should bring $120,000. Nobody will buy asset like that. In that case, the reason is within management control. It's management that did not price the asset well. That is why the asset is still in existence. Or management did not actively market the asset. So nobody got to know that the asset was even for sale. The asset was not even demarcated. They parked the asset at a certain garage And nothing, no information was brought out again, nothing. So in this case, the issue or the reason for the delay is within management control, and hence the asset must be reclassified to what? Have to reclassify to mainly for use. So you do a reclassification. I'm done with the recognition. So this is what you must know under the recognition. And let's go to the measurement and disclosure. That's all. Measurement and disclosure. Recognition simple means the conditions that we have to meet before we can record them. And then how do you record the non-current asset held for sale? So we are going to the measurement aspect and then the recording. So let's go measurement. Measurement. So measurement. During the question solving stage, I will project a lot of questions coming from ICAGAN and ACCA, which talk about these conditions. Yes, so take notice. Measurement basis. Measurement talks about the value. How do we obtain the value? So measurement basically will talk about the value. So take notice of that. So measurement of the asset. So now, the entity have to measure the non-current asset or disposal group as held for sale at the lower of 2. So please take notice. So here the measurement is at what? Lower of. Compare two values and select the lower. Lower of carrying amount and fair value less cost to sell. Less cost to sell. That is it. So basically, so for IFRS 5, all the non-current assets and disposal group, so third examiner, is for both non-current assets held for sale and then disposal group. Take notice. So it is for non-current. Let me make it this way. Non-current asset held, non-current asset or disposal group. As a discontinued operation. You see that sometimes you have an asset, a group of assets that are going together, disposal group. Or you can even have an entity, an operation that are going for sale. So that is where we are coming from. Good. So take notice of that. So we are done with this. Take notice. Then after, so this is the initial, at the initial point, the lower of carrying amount and what fair value less cost to sell. So let's continue. So imagine that we have an asset, the carrying amount is 20. Fair value less cost to sell is 15. We selected 15 because 15 is lower than 20. Here you must know how we should account for how should get the carrying amount. So during the question solving stage, we'll pick some of them and illustrate how you can go by all these figures before you can compare them. Okay. So take notice. Now, an initial date. So at the initial, take notice of this, very important. At the initial measurement, so the very first time, two things will happen. One, if the fair value less cost to sell is lower, comma, impairment loss must be recognized. Impairment loss must be what? Recognized. So take notice of that. So you record impairments if record impairments as soon as the fair value less cost to sales becomes lower. That is it. Yeah, so this is part of the first measurement. So here we don't have different measurement criteria both for initial and subsequent. IFRS 5 is a standard that gives the same measurement for initial and subsequent. At any point in time, you still measure the asset at the lower of what? Carrying amount, and then the its fair value less cost to sell. So we don't give, so that rule runs through all. Unlike inventory, you see, inventory initially we measure it at cost. Subsequently, we measure at what? Lower of cost and NRV. But with non-current asset held for sale, at every point in time, it must be measured at the lower of what? Carrying amount and fair value less cost to sell. So if you check carefully, I never gave initial measurement and subsequent measurement. I gave a rule that for all non-current asset and disposal group, for all non-current asset and what? Disposal groups. So take notice of that. Now, an initial measurement, the very first time you meet the conditions, if, so let me give typical example. If there's an asset, so let's say we have a plant. I want to give example. There's a plant here. So example. So imagine that Target PLC, PLC acquired a plant, production plant at or maybe for dollar of $100,000 on first of July 2010 with an estimated useful life of, let's say, estimated life of let's make it 10 years, full stop. On January 2015, management decided to classify the plant for sale. So for sale, but the assets was available for sale on 1st day of July 2015. Full stop. Okay, so the fair value less cost to sell. So you see the game, fair value less cost to sell at that date was $70,000. That's all. Let's make it 65. Should be okay. So $45,000. Done. So first of all, we need to find the carrying amount of the assets. So first, right here, plant solution. We are solving it. Do this. Carrying amount of the assets. And then the fair value less cost sell. That's we are done. So take notice of this. This is a very short, interesting example. I wanted to add a lot of stuff, but let me pop up again. Now, take notice of this. The cost of the asset is $100,000. It's for 10 years. So 10 years. So ideally, the depreciation will be 100,000 divided by 10, so 10,000 a year. They never said which method of depreciation, please. We didn't tell you, just adopt the straight line method and go. So that will be 10,000 each year. On January 1st, January 2015, management decided to classify the assets but they decided to classify the assets as held for sale or classified for sale, no problem. But the asset was available for sale on 1st July. So where exactly, per the requirement of IFRS 5, which of the dates, which of the month can they record the asset as held for sale? Is it January when they decided, when they make the decision, when they plan to sell? Is it when they plan to sell the asset or when the asset was available? So July, the asset became available for sale. But the plan was initiated somewhere January 2015. So where exactly are we looking at? Which of the months? Will it be January or it will be July when the asset was available? That's all. Not when you make your mind. You see, a lot of people have plans though. Enter into people's mind. Their plans, even the debt, even the ghosts have what? Have plans. So if your plan is not into action, forget about it. So here we are talking about when the asset is what? Available for its immediate sale. And this asset is available for its immediate sale on first day of what? July 2015. So please, it means that we have to depreciate the asset right from the beginning up to this date. Take notice, right? Up to this date. So let's go. So first of all, cost of the asset. So tell the examiner cost of the asset is $100,000. Accumulated depreciation, help me out. So from 1st July 2010 up to 1st July 2015, how many years and how many months? So 2010. Please here, don't feel shy to count your fingernails. In exams, they will never, after passing, they will never write anything on your forehead so that this student counted the fingernails. So count. July 2010 up to July 2011, that'll be 1. 12, 2. 13 will be 3. 14 will be what? Will be 4. And 15 will be what? Will be 5. So that will be 5 solid years. So this is held for sale 5 years. So if each year depreciation is 10,000, 5 years will be how much? So it will be 100,000 divided by the 10 years. This time around times 5 years. That will give us what will be the accumulated depreciation. So that should be 50,000, right? Good. So that will be $50,000. So I don't think the current amount, as at the date of classification, is 50,000. That's the current amount of the assets, 50,000. And the examiner told us that the fair value less cost to sell at that date will be 45. Please, if you use January, it will be 4 years and 6 months. So for those who use January, 4 years, 6 months, but don't use that one. We are begging you. So the fair value less cost to sell is 45,000. So fair value less cost to sell. So fair value less cost to sell is $45,000. At the end of the day, we compare $45,000. So this is what I was explaining to you, that at the very first day, you classify the assets. The very first day, you classify the assets. All what you have to do is that you compare carrying amount against fair value. That's cost to sell. There's a condition here. I give a condition. The conditions are 2. 2 things will happen. Either the fair value will be fair value less cost to sell will be lower than what? The carrying amount. So if the fair value less cost to sell is lower, then immediately impairment loss must be recognized. And this is the treatment. You debit P&L with a loss, and you credit the carrying amount of the asset. That's all. Debit P&L and credit the carrying amount. We are done. So that's what we see here. So immediately, there must be impairment loss of 45,000 minus what? 50,000. So what's the difference? So there should be a loss of 5,000. So impairment loss of 5,000. So take notice of that. So impairment loss of $5,000 have to be recognized. Treatment is you debit P&L, you credit carrying amount of the asset. So at the end of the day, the asset value the new value after first recognition will be what? Will be 45,000. So we are reducing the 50 to 45. That is the treatment, and that is what I'm explaining here for you. Finally, I'm still at the initial stage. What if the fair value less cost to sell is higher? So if the fair value less cost to sell is higher, comma, in that, what you do? You only have to disclose. So just disclose. You only need disclose. So at the initial stage, you must disclose. Take notice of that. So at the initial stage, kindly disclose. So basically, that is that. So please get this clear for me. Then I go to the subsequent, then I'm done. At the initial stage, this is what you have to do. Let me ask for questions. All right, so that is that. Now, if the fair value of less cost to sell is higher, you just have to disclose. So here you do nothing. Please do nothing. Meaning, do nothing means no debit, no credit, no passing of entry. You just have to pass a footnote, a disclosure requirement. Just a disclosure requirement that, oh, at the time of reporting, the asset value, the asset fair value less cost to sell was above was carrying amount at the initial measurement when the asset was classified. Something like that, summarize it and then move. Yeah, when you are debiting P&L, it means you are treating as an expense and you're reducing the asset carrying amount from 50,000 to 45, and that's all. So I'm done. So imagine this question. This side was, let's say, 55. That will do nothing. Do nothing. In that case, but I just disclosed in the footnote that the fair value was above the current amount by $5,000 at the reporting. Take notice. Now let me go to the subsequent issues. Subsequent measurement. So subsequent measurement. Subsequent. So subsequent measurements. So that's after the initial measurement, the following ones. Maybe at the balance sheet date, at the reporting date. Here there are rules. Still, first rule number 1, take notice of this. So no depreciation. I repeat, no depreciation. No depreciation. So we don't charge depreciation as soon as you classify the asset for sale, because there's no consumption of economic benefit. What the wow. We are not using the asset. The asset, we don't put the asset to use. We stop using the asset as soon as. So those people that are using the car and still go ahead and then they've written for sale on the car. We are watching you. IFRS 5 is watching you. Yes. As long as you classify the asset for sale, stop using it and stop depreciating it. Keep the asset intact. Whoever comes will get it and move. Because if you could put the asset to better use, you do not classify it for sale. I'm not classified for sale. If you know how to use this asset, why are you selling it? So why do you write for sale on it and you are still using it? So vehicle owners, who have for sale on their vehicle and they've used for 1 month. Okay, so that is that. Take notice. So after the initial, so let's just assume that target professional consult, good. You see, but don't forget that target professional consults in 2015 they will depreciate the asset from January to July. So that one they will depreciate it to go to P&L, normal depreciation. But as soon as you classify thereafter, that is where the depreciation doesn't matter. We don't depreciate it again. So in 2015, target professional consult must depreciate the plant for only 6 months. And 6-month depreciation must be recorded in a P&L, which will be half of 10,000, which will be 5,000. So at the end of the reporting period, so what happened to the asset? What the P&L? The first thing, depreciation must cease. And when depreciation ceases, it means that the consumption of economic benefit also cease. And then that's all. I'm done. Another issue that you must take notice of, number 2, the asset must still be measured. The assets must still be measured at the lower of carrying amount and fair value less cost to sell. See, you see the condition? Very interesting. The asset must still be measured at what? Fair value less cost to sell. The asset must still be measured at what? The lower. And 2 things will happen. Yes. So 2 things will happen. Let's go to III. So if at a subsequent date, so if fair value less cost to sell is lower, more impairment. So that one command impairment must be recognized. Additional impairment. So impairment must be recognized. So that for that one, no big deal. But watch careful. The number 4. The number 4, please watch number 4 careful. The point 4. That is where all the issue is. So the number 4 is where you have to take notice of. That one is a bit slippery. You can fall inside and you sleep. No wake up again. If the fair value less cost to sell is higher. We normally call it subsequent increase in fair value less cost to sell. That's the nickname. Subsequent, let the examiner, subsequent increase, what a wow, in fair value less cost to sell. What do you do? Yes, so that we call it impairment reversal. So you see, in that case, there must be a gain. So we call it subsequent gain. So we call it subsequent gains. Subsequent gains. Not the initial gain, though. Take notice. Initial gain, we don't record it. Let me go there and tell you. Here's it. This one, initial gain, we do nothing. So at the initial stage, if the gain, if the fair value is more than the carrying amount, do nothing. But the subsequent gain is the only one that we are interested in, the subsequent gains. So take notice. So subsequent gains. How should we record it? Yes, it must be recorded as a gain. So I'm going to provide a detailed explanation of this. As soon as I'm done with this, that's all for IFRS what? IFRS 5. And then the presentation, I'll just give you a format, the presentation of it, and we move on with the game. Now, if you get a subsequent gain, the standard stated clearly that the entity shall recognize any gain. Yes, so any gain, but not in excess of the cumulative impairment loss. There's a quota. Take notice. So you can record impairment. Impairment has no quota, but the gain has a quota. So entity, so let me write it fully. Let us examine that the entity shall recognize a gain, subsequent gain of an asset, but not in excess of its cumulative losses. That's the impairment loss. So the entity shall recognize subsequent gains on assets held for sale, on asset held for sale, asset held for sale, on asset held for sale, 0, but not in excess, not in excess. So that side is where you have to take notice of. Let me slow down. But not in excess. But not in excess. But not in excess of its cumulative impairment loss. So not in excess of its cumulative impairment loss. Okay. There's a problem with it. Oh, okay. Okay. I'm coming. Oh, you're going now. All right. Now, but not in excess. In excess of what? Cumulative impairment loss. That's all. Done. You're done. Not in excess of cumulative impairment loss. That's the quota. That's the highest impairment. That's the highest gain you can record in the books. So basically, that is that. I'm done with the game. So subsequently, take notice of all this stuff I've written here, and they are very important. Please take notice of it too. This side is where final level 3, we normally use to reduce the pass rates. So you see us giving you the initial measurements, you get it right, and you go to the subsequent one, and then it will be. So take notice, and then we are done with the game. Now, let me move on and then we are free to go. Now, all right, so that is that. Please. So if I should continue the examples I gave. So again, example. Let's assume that, so from the previous example, so from the previous example, page number, what page is that? Now, what page number is that? Let's go. Example that I gave is in page, so page 14. So example 1, page 14. Good. So let's assume, so they classified it where? July 2015. So December 2015, what will happen there? December 2015, what will happen there? Page 14. So let's assume that something happened. If at December, so if at 31st December, that's the reporting period of target professional consult, the fair value less cost to sell is, so let's just assume that A, or is somewhere, what's the fair value? 45. So A, it was, let's say, let's just assume maybe 40. Let's just assume that two scenarios. Let me even give 3 scenarios. B, C, A. Let's just assume that the fair value is as usual, $40,000. Do it. B, the fair value is, in fact, $47,500. The last one is C. What if it is $52,000? What a wow. So you are required to prepare how the financial statement will look like. Let me see if I have any space. I'll do that there. Wow, I've exhausted all the pages with my signatures. All right, so I'll do it and then move on the rest. Now, all what you have to do is that first, let me do A here. So scenario A, scenario B is stay with us so you can get everything clear. I'm doing A here, I'm doing B here, and I'm doing C here. How will it happen? What will happen? First thing, you still compare, right? The plans. Lower of current amount and fair value, less cost to sell. What is the carrying amount? The carrying amount is $45,000, please. Carrying amount is $45,000. But that's now A. Fair value less cost to sell is $40,000. Yeah, $40,000. Of course, 40,000 is lower than 45. Of course, 40,000 is what? Less than 45. So in that case, additional impairment to be recognized. So further impairment, what a wow. So here there must be additional impairment of 5,000. Yes, in the previous question, you see, there's a question here. Why in the previous question, the current amount, yes, the current amount we had, you see this? Yes, after the first measurement, this value vanished. The 50,000 is wrong because it's not the lower. It's vanished from the books. So after the very first measurement, the asset is carried at the lower. So we cannot use the 50,000 again. So we have to use the 45. So that's the lower. So for the next valuation, the current amount becomes the lower of this. No depreciation. Good. So the current amount will not be 50. It will be the 45,000. So now there will be additional impairment of $5,000. So in summary, depreciation will be, there will be depreciation of $5,000. How do I get a $5,000 for depreciation? Let me show you how I got a $5,000. See, the asset, the cost is 100,000. And over 10 years, that will be 10,000 each year. So 10,000 depreciation per year. Then for 2015, the asset was used from January up to when? Up to July, first day. So July is not past. So maybe effectively the end of June, 6 months. So if the whole year is 10,000, depreciation for 6 months will be what? Only for 5,000. Then we move on with the give. So that's how come I got a depreciation of what? 5,000. So depreciation will be 5,000. Then total impairment. So for that particular year, the total impairment will be how much? $10,000. Then you agree. 5,000 was as at 1st July, and another 5,000 as at 31st of December. That's all. Making what? Yeah, it's coincident that it's 5,000, 5,000. Finally, what will be the asset value? All this goes to P&L. With the statement of the financial position, the plant carrying amount will be stated at what? $40,000. So the plant will be stated at $40,000. I'm done with the scenario A. Let me go to scenario B. By the time I finish the entire storyline, you will be very clear with all the statements we made. Let's go to the second scenario. In all the scenarios, you must tell the examiner plant. We still measure lower of cost, carrying amount, and fair value, less cost to sell. What's the carrying amount? It will still be dollar of 45,000. This time around, they are telling us that the fair value less cost to sell, what they say. Fair value less cost to sell is what? 47,500. Wow. So 47,500. So here there's a gain. There's a fair value gain of 2,500. Yeah, so we can recognize the gain. Yeah, so the gain should be recognized. Yeah, so we have to recognize the gain of 2,500. So 2,500 must hit our account. So fair value gain on. So OCI will take that. Okay, so why not? There's a question here. Why are we not using 40,000 as a carrying amount? No, please. All these questions, it's not like A is like after B and B is all of them on their own. All of them are taking effect from the beginning. So B is assuming that A is not there and C is also not there. What will happen? That's how we are doing it. At the same time, A is also assuming that B is not there, C is also not there. All of them are independent. They are not dependent questions. So there will be a gain of 2005. So you record again. So in summary, the gain goes to OCI, OCI. So summary. But here, we cannot record it in OCI unless it has what? All the previous impairment loss has been like wave off. So we can use this one to reduce the last impairment, the previous impairment. So in summary, here we cannot record again until the previous impairment has been what? Cancelled from the book. So for example, the summary. Let's go to the summary point. So here we cannot record impairment. There's no impairment here. Still, there will be depreciation. Take notice. Depreciation of what? Still $5,000. Doesn't change. And we now record again. So it will be in the P&L. So this gain will go to P&L. It is reversing the previous impairment charge. So we have to record. No, we cannot credit OCI. We will credit P&L because it is reversing the previous impairment that they have charged on the same asset. So it is reducing it. You get it? Good. So here we can use it to reduce the impairment they've charged. Previously they have charged impairment of 5,000 and today they've made a gain. So therefore we have to credit P&L to the tune of what? 2,500 as the gain. And then that is it. Yeah, so the corresponding entry yeah, so If the fair value, I have a question here. One says, what if the fair value? You see, the fair value will be higher at the initial date. At the initial date, that's why we do nothing. The very first time when the fair value is high, don't do anything. So that is it. Please take notice that this gain or loss is in line. It must be in line with IAS 16. The subsequent gain or loss should be in line with IAS 16 or IAS 38. Take notice. So whatever IAS 16 says about revaluation gain and revaluation loss, have you seen IAS 16 describe the reversal of what? Revaluation loss when there's a gain. Likewise, so that is what we are treating now. Good. And then that is it. So here we have to reverse the previous loss. And here we will probably debit our reserves. So the reserves have to be debited. Good. The reserve have to be debited. And again, the plant have to be measured. So at the lower of cost, and then its fair value less cost is so. So take notice of that. So take notice of that. So we have to. If the sale goes beyond 1 year, or expected beyond 1 year, the entity shall measure the cost to sell in its present value. It's true. I have to explain that one also to you. Okay, so let's go to the P&L. So the plant to be measured at the lower of fair value, let's go to sell, and its carrying amount. So you still have to include $45,000 here. And this each other entry goes to the reserves. So we can debit the other reserves and then we move on with the gain. Over here, see, we are still recording plants, lower of carrying amount and fair value less cost to sell. So here, the carrying amount is still $45,000. But here the fair value less cost to sell is $52,000. So there's a fair value gain of what? $7,000. Good. Over here, good. This fair value gain, we could reduce. We could reverse an impairment. So we can reverse the 5,000 impairment from this, and then we can now record again. So here, even though the gain is 7,000, we could only record. So again, the maximum we can key in is what? 5,000, not the entire 7,000. So here, the gain is restricted. That examiner, it is restricted to 5,000. Take notice. And that is what we wrote here. That is what we wrote here. Where? Wrote somewhere. Good. If the fair value cost to sell is higher, the subsequent cases. So subsequently, that's subsequent gains. And I wrote something again. Now the entity shall recognize subsequent gains of an asset held for sale, but not in excess of cumulative impairment loss. So all the impairment loss you charge cannot record a gain much more than. So a gain of what? 5,000 have to be recognized. Again, depreciation will still be available on the assets, which will be $5,000. I wrote Ghana dollar. Depreciation will still be $5,000. Finally, asset value will still be at the lower of cost. That will still be 45,000. So the plant have to be stated at what? 45,000. The last issue is that if the sale is expected to go beyond 1 year, you must find the present value of the fair value less cost to sell. Take notice. And then that's all. So on that note, that's all. The rest is the disclosure requirements of IFRS 5 held for sale. And then we move on with the game. And can you join us when we are solving practical questions on the this fair value subsequent value? No, we cannot record the excess gain. The highest gain we can ever record in a book is 5,000. We cannot go in excess of all the impairment that we have had so far. So the 2,000, we do nothing. So have you seen that do nothing? Ignore those stuffs. Will come in here. All right. Now, I also promised you that I will tell you how we present them, please. Yes. So let me go to that side. Very important. Where can I do it? So let me do it here. Take notice of this. Very important. I nearly forget about it, but presentation of discontinued operation. How do we present it? So now I'm with non-current asset held for sale. Let's go to presentation. Presentation of discontinued operations. Now the presentation is very key. Take notice. The standard prescribes how we should present it. How we should present discontinued operation. So here, we normally present it separate, a major line. When you say discontinued operation, it's a component of an entity that has been disposed of or classified as held for sale. So let me define discontinued operation. That is what? A component of an entity that has been what? Disposed of or classified as held for sale. Held for sale. So when you talk about discontinued operation, that's the meaning. Either a component that we have sold or we have made our mind to sell it. Sorry, my pen has gone down. Yes, that's enough. So a component, so imagine target professional consults, we have 3 divisions. We have 3 components. We have the consulting and then the teaching. We also have the publication aspect. And then finally, we also have the food manufacturing aspects. Good. So imagine we decide to sell the publication aspect or classify the publication aspect for sale. How do we present it in our account? Very interesting. But now we are done with what? The non-current assets, the individual assets that we are selling, we are done with it. We are now going to like a component in a geographical area. Take notice. So sometimes it represents a separate major line of business. Please. IFRS 5, the following are what? Meet the definition of what? Discontinued operation. Take notice. So there are three. Another definition. So it's a component of an entity that has been disposed of or classified for sale. Let the examiner. And so any of this. So and A represent a separate line of business. Take notice. A separate line of business. Separate line of business. Or geographical area of operation. Or geographical. So London office or Southern division, provided that they operate on their own. It can be. There was one question that I think they met IFRS 5 and IFRS 8 segment reporting together in one question. That question came in ICA May 2018, question number 2. ICA May 2018, question 2. They asked them segment reporting, IFRS 5 was asked. So they merged the two together. I wish you could solve that question. Maybe in our question solving, I'll pull out all those questions, and it's very interesting. Then number C. No, I'll solve that question before I go. So please don't go. Yes, I'll solve before I go. Information which me suggests I have to solve it. That's the second aspect of it. It's part of a single coordinated plan to dispose. So there's a plan. It's part of a single coordinated plan to dispose. So like it's form part. And it's part of a single coordinated plan. Single coordinated plan to sell. So take notice of that. And this is how you go slow. So take notice. Coordinated plan to sell. Then the next point we could talk about the C. Then I'll now do the presentation and go. And it's a subsidiary acquired exclusively with a view of what? Resale. So take notice. A subsidiary acquired exclusively for resale. So acquired for resale. That's all. So this, according to IFRS 5, discontinued operations are this. Now, what is the accounting treatment? It's about disclosure. So take notice. So let's go to the accounting treatment. Very important of discontinued operation. So accounting treatment, that's the presentation or presentation. First of all, tell the examiner that the entity shall disclose. It's a disclosure. Entity shall disclose the following. The first thing, the post-tax profit or loss on discontinued operation. So here, a single amount in the statement of the comprehensive income. So the entity shall disclose, number one, a single amount in the statement of comprehensive income. That amount should comprise of one, post-tax profit or loss of discontinued operation. So post-tax profit or loss from where? Discontinued operation. So you have to disclose this as a line item. Take notice, so you might disclose this as a line item. Item number two you must disclose is the post-tax gain or loss on the measurement of the fair value. So that's the here post-tax profit or loss or gain or loss after disposal. So this post-tax profit or loss after disposal. So these are the two that you put together and you get the. I'm done. Let's go to the balance sheet. On the balance sheet, what do you do? On the balance sheet, what do you do? So on the balance sheet, you present it under the, that is, if it, you have not disposed it of, so you present it under the non-current asset. Yes, so you present it on its own. So a single amount in the statement of financial position. Single amount in the statement of financial position, the balance sheet, and a non-current asset, please present it and a non-current, separate and a non-current asset. I'm done. So that's the disclosure and that's the presentation of it. So basically, I'm done with the game. And additional disclosure, the disclosure requirements, you might describe the non-current assets or the disposal group. So that's the additional disclosure that You have to also disclose the fact, and then the circumstance of the sale. And then you must also disclose the gain or loss. And then the applicable reporting segments under IFRS 8 segment reporting. So that's the disclosure requirement. And if we get to know this, it means that we are free to go. All right, let me see if I can back this with some few illustrations for you. There's some question that I will want you to look at this question. And then we move with the game. So let me see if I can direct you with a lot of questions that I see have asked on this. I asked for, let me check this. This is the ICA pool question. Kindly register with us, Target Professional Consults, and have access to all this free material. This is the ICA past question from 2010 up to the last sitting. It even includes the next sitting's questions. Just get registered and have access to them. As soon as you register, they become free. So let me go to IFRS 5, random search. I need May 2018. If you don't give it to me, I'll go there myself. I need May 2018, IFRS 5. I need May 2018. I need the one under May 2018. I don't need any other IFRS 5. Good. This is the May 2018. Thank God I've seen it. So D, explain with justification whether each of the following could mostly or could most likely be classified as discontinued operation under IFRS 5. I like this question. This May 2018. Question number 2D. May 2018, question 2D. A reportable operating segment that met the definition of held for sale after the year end, but before the financial statements were authorized for issue. So, can we classify this as held for sale? That is a question that we have to ask ourselves. So, you get it? This is a typical question. So, get it for us. So, you see, this is IAS what? IAS 10, event after reporting period. You see, they make the definition after the year end, but before the financial statement were authorized. That's IAS 10. This is a final level exam question, but IAS 10 are featured in. This question is IAS 10, IFRS 5, and small of IFRS 8 segment reporting. And it's going for 1 mark. They just tell us whether they have met it or not. If you're able to tell us whether they've met it or not, that is all. We don't penalize whether they can classify as held for sale. So you can let me know if you could go ahead and classify it as held for sale. So if they could, you let us know. This is what someone wrote as final exams. 1 mark. So take notice of that, and then we move on with the game. All right, so let me solve it. Ideally, this IAS 10. In fact, the definition of discontinued operation were not met before the year end. So in that case, disqualified. Okay, so you get it. They made the definition after the year end, and hence we cannot classify it as held for sale. Not at all. See, they made the definition after the year end. Like the question I gave you, they made the definition after some time, but that word is within that year. But the question I said, just relying at the question we solved. Let me go there. The question, good. You see, they started it somewhere January, but they made the definition July. But all of them are within the year, so they have no problem. But if it go beyond after the year and lease and place again, they have no IFRS 5. So I'm down with that one. So we cannot record. So at the year end, we cannot record. So we can't. So let me go to the next one. And the next one, you try your hands. So the next one will be okay. So there's a question here. Let me say. So if it was within the year, oh yes, that one within the year, they qualified. So that one we can record within the year. Yeah, because we are disqualifying it because it was not within the year. And let's go to the second one. A reportable operating segment that was closed down. That was closed down. The aspects of the segment were broken up and used in other divisions. Let's qualify. I wrote something, some points be there. I wrote some 3 points. Examiner is coming for one of them. I wrote 3 points. Let me show you the point I wrote. And in it, you can deduce the definition. Let's go. So, good. So from here, I define discontinued operation as what? As a component of entity that has been disposed of or shut down. So add it to it, or shut down. It has been disposed of or shut down or discontinued. That's all. That's all. Which represent what? A separate line of business or geographical area of operation. That's all. So in that case, it's qualified to be classified as what? Held for sale. So operating segment that was closed down, qualified. It was closed down during the financial year, not after the financial year. So hence they qualify. That's all. Because it formed major part of business and it was disposed of during the accounting year. It qualified. That's all. It was disposed of. So I'm done with the second one too. Have you seen how nice and interesting it is? No, you see, examiner was trying to confuse us more by lie bad. Let me show you where the confusion came from. We have closed down. So you see, I have an asset, a segment report. One branch has been shut down. If we shut down the operation, tell me what are we going to asset for? You may sell the asset or use it for something else. But the underlying factor is that you have discontinued the entire operation. So that entire operation you have discontinued, you have closed down, it qualified. Even if you use the assets of that unit, even if it's for something else, you are not using it in the same operations again. Take notice. So the use over there was that to just confuse that. If they were using it in the same operation, then they have not discontinued the operation. They are using the asset in the same. And when they change the use of the asset and shut down the main operation, so does it mean that when they shut down, they should just look at the asset like that? Either they will sell for money or they will put it to different use for the same money. They are selling it for money. They know that they can't get it money from the current use. So they have to change the use quickly. And that is it. Did you get it? I was very clear. Good. And the last one is very important. And then I think that one you explain it. I think I mentioned it. Let me go to the last one. How many marks? 1, 2, 2, making 5 marks. It says that a division of a business classified as held for sale that was correctly treated as discontinued operation in last year's financial statement, but has not been sold by this year end due to the sale being referred to the National Insurance Commission, which regulates the insurance industry. The commission is not expected to report its findings until 6 months after this year end. So can they still classify it, or they should do what you call reclassification? What a while. Have you seen that this one? We've answered it. You see, 1 year has elapsed. They classified last year. So ideally, by the end of this year, we must sell the asset. But the asset is still there. But we need to take permission as the regulations specify from National Insurance Commission. And they don't expect to bring their findings anytime soon, until 6 months after the year. So it means that it will be 1 year, 6 months. So do we have to continue the reclassification? So do you have to continue classify the asset as discontinued operation, or rather we should do reclassification? And here we have to do what? We have to continue classify the assets. That's all. And nothing else, nothing more. Why do we have to continue? We have to continue because the reasons go beyond management control. Management does not control the regulation. Please, I'm done with IFRS 5. Please go through all the videos, subscribe, share with your friend. Please, if you have any questions, put them in the comment section. I'll pick them and then answer them. To join the class and then we'll move on. If you have a question, kindly ask the question. The last question, okay, the last question we solved. You see, on the last question that we solved, after the year end, they've not sold the assets. Even after 1 year, the assets have not been sold. So ideally, we need to reclassify the assets back to what? Back to usage. Just that if the condition is within management control, but here the condition for the asset not being sold goes beyond the entity's control, because the regulations stated that they have to refer to National Insurance Commission before they sell the assets. So hence, the asset, the division must be classified as what? Held for sale. So the definition, they have to continue classifying it because the condition is not within their control. So they will continue classifying it as held for sale. And that's all. All right, so on that note, we are done. I can show you where you can find this. Let me show you where you can find this answer. Yeah, it's on the subsequent measurement where I give the subsequent measurements. Where I give the subsequent measurement. Let me go there. Let me go to the subsequent measurement, no depreciation. No, I gave it another condition. Yeah. Good, yes, it. After 1 year, take notice of this. After 1 year and the assets remain unsold, if the reason is beyond the entity's control, then they can still record, or the asset can still be classified. So yeah, I was saying the asset can still be classified as what? Held for sale. If it is within management control, then the asset cannot be reclassified. And that's the question they're asking you here. I hope it's very clear, friends of mine. All right, so that is it. All right, so I'm done. And if you have a question, can you put it there and we'll move on. IFRS 5 I've been dealt with. Now we are doing this complex IFRS. Then move on to the game. All right, if there are no questions, then permission to end the section, please. Kindly register with Target Professional Consult, your last stop for concise explanations. Please join our WhatsApp group where most of the information is shared over there. Kindly click on the registration link and register now and have access to all these materials, all these documents. Have access to them, and then we move on with the questions. I'll bring out the questions and then we move on. And the final answer is that the asset will classify as held for sale because the reason is not within their condition, within their power. So take notice of that. All right, so thank you very much for joining us, and we wish to see you. Please, yes, let us hear from you. Register early to save your slot to first come, first serve. We'll move on. Okay, so bye-bye, and to meet again.